Welcome to The Explainer. We're going to jump right in and break down what's really shaping the market today, August 18th, 2025.
All right, let's just rip the Band-Aid off and ask the one question that's probably on your mind. Just how risky is the market right now?
Well, believe it or not, one key indicator is giving us a really specific number to work with, and that number is 263.01. Now, just as a number, it might not mean much, but it's pointing to some serious market stress.
And that number, 263.01, it translates to a pretty clear warning. I mean, there's no ambiguity here. According to this model, we are smack dab in a high-risk zone.
So, okay, high risk. But what is this indicator and how in the world does it come up with that number? Let's kind of lift the hood and see what's going on underneath.
All right, this is what's called the Mannarino Market Risk Indicator, or the MMRI for short. And, the formula itself is actually pretty straightforward. It just takes two huge market forces, the strength of the US dollar, that's the DXY, and the yield on the 10-year Treasury, multiplies them together, and then divides by a constant to get that risk score. Simple, right?
And this is where it gets interesting. You can see how that number, R263, fits into the grand scheme of things. The indicator has these different levels, from low to extreme risk. And, yep, there we are, sitting right in that high-risk bracket. Now, it's not run for the hills extreme risk just yet, but it is definitely a sign to be paying very close attention.
But you know how it is. One number, one indicator, it's never the whole story, right? So let's zoom out and get a look at the broader market to see what's really going on.
And wow, right away you can see the market has a total split personality when it comes to commodities. On one side, you've got precious metals like gold and silver doing pretty well, helped by those lower treasury yields. But then you look at energy and it's a completely different story. It's struggling because of worries about lower demand. It's like two different markets living under the same roof.
And this right here is where things start to get, well, a little confusing. We have that risk indicator flashing red, right? But at the same time, the overall U.S. economy actually had a huge bounce back in the second quarter. I mean, it grew at a 3% annual rate after dipping a bit in Q1. That's a really strong comeback. So what gives?
And if we dig a little deeper into that growth, we can see exactly where the engine is. Over the last year, it's really been driven by heavy hitters like financials, consumer discretionary, and industrials. So this isn't an economy that's weak across the board. Not at all. Some parts are actually doing really well.
So this all gets into how traders try to read the room, the market sentiment. And a classic way to do that is by watching stocks hitting their 52-week highs and lows. These aren't just numbers on a screen. They're huge psychological triggers. A stock hits a new high, and suddenly you've got FOMO, that fear of missing out, kicking in everywhere. A stock hits a new low, and people start wondering if it's a bargain. These levels really define the battle lines for traders.
Okay, so with all that as our backdrop, the high-risk signal, the growing economy, let's get super practical and look at what's happening today that could push the market one way or the other. So keep an eye on your watch this afternoon. On the government side, we've got a couple of big data drops. First up is the Housing Market Index. That's always a great reality check on how consumers are feeling. And then after that, we have some Treasury bill auctions. That'll tell us a lot about how hungry investors are for safety right now.
And it's not just government data. It's a huge day for corporate earnings too. Before the opening bell, we're going to hear from EV maker Polestar. And then, once the market closes, we get the big ones. Cybersecurity giant Palo Alto Networks and the mining powerhouse BHP. These reports are like getting a direct look inside these massive industries.
Okay, let's take a breath. How do we connect all these dots? We've got this one indicator screaming high risk, but then the economy itself seems to be saying, I'm growing. And on top of all that, we have a ton of new information hitting the market today. It's a lot to juggle.
And this is probably the most important thing to remember. An indicator like the MMRI, it's an amazing warning light on your dashboard. It's great for flagging potential trouble. But it is not a crystal ball. The folks who created it even say, hey, this is a tool, not a prediction machine. You have to use it along with everything else you know.
So really, the big takeaway here is about having a process. It's a simple three-step way to look at the market. You start with that high-level signal, that flashing light from something like the MMRI. Step 2, you broaden out and check it against the health of the actual economy, things like GDP and which sectors are strong. And then step 3, you zoom right in on the daily stuff, the earnings reports and data releases that can change the story on a dime.
And that really leaves us with one final question to think about. When you're in a market that's sending you all these mixed signals, where one thing is telling you to be cautious, but another thing is telling you there's growth, what do you look for? What are the clues that tell you the real story?